Hi everyone, welcome back for SoundView's monthly recap. I'm Misty Lynch and happy July. We have officially crossed the halfway point of 2026 and what a first half it has been. Today we're going to break down three things, kind of what happened in the markets in June, zoom out and look at the bigger picture for the first half of the year, and then because it's summer and we're all thinking about what's ahead, I want to give you some actionable tips for the second half of the year, both from a market perspective and a personal finance standpoint. So let's get into it. So for June, the headline is this: after an absolutely blistering spring rally, the market took a bit of a breather in June. And honestly, that's not that surprising at all. The S&P 500 snapped a 2-month winning streak in June, falling about 1% as investors worried that previous AI rallies might have gone a bit too far. Meanwhile, the Dow actually rose 2.5% in June as investors rotated away from techs and into financials, healthcare, and industrials, other sectors where the Dow has a little bit more exposure. And the big story of the month was what happened to some of the mega cap names. Microsoft fell 17% in June, which was its worst month since 2000. Oracle fell 35%, its worst month since 1990. And while these are eye-catching numbers, but there's important context around this. Despite that June swoon, the S&P 500 and the NASDAQ still posted their best quarterly performance since 2020, with the rally in semiconductors, memory chips, and these things carrying the market. So an index tracking semiconductor stocks surged almost 88% since March, its best quarterly performance on record. And according to FactSet data going back to 1994, this was pretty impressive. So what was behind the June pullback? I guess a few things. Investors had to weigh 4.2% inflation in May, which is the highest in 3 years, against the ongoing fever for AI stocks and concerns about rising interest rates. And sitting at the intersection of all of this is a new Fed chair, Kevin Warsh, whose first formal test might be arriving. The sell-off in U.S. Treasuries recently took some yields, like the 30-year yield, to their highest level in years. So the bottom line for June, it was a healthy overdue pause, but really no need to panic. So let's zoom out. How did the first half of 2026 actually look? The answer is remarkably well, considering everything that was thrown at it. The stock market surged over the first half of the year, shrugging off a war in the Middle East, a historic oil shortage, and the fear of a bubble in artificial intelligence. The Dow is on pace for its best first half since 2021, climbing 8.9% to top 5,200, and the S&P 500 jumped 9.4%, and the tech-heavy NASDAQ soared 12.5%. All told, the S&P and the NASDAQ are up 9.55 and 12.79 respectively. The S&P cinched 24 record highs in 2026, and we're near another one. In small caps, the Russell 2000 is up 21.9%, so this is quietly one of the most impressive numbers of the year. And what drove these three things, mostly corporate earnings. Corporate earnings broadly exceeded expectations, with roughly 97% of the S&P 500 companies having reported by late May, and 85 topped earnings estimates, which is well above the 5-year average of 78%. And Wall Street analysts now project S&P 500 earnings growth of 25% for the full calendar year, up from less than 16% at the start. The second big thing is the AI spending boom. AI spending expectations have increased dramatically, boosting across manufacturing, construction, materials, energy, labor markets. The top 5 mega cap developers are expected to commit $723 billion in 2026, up by more than $100 billion from the start of the year. And the third is a resilient economy. Better than expected job gains have helped dispel some fears about recessions. The labor market added a robust average, about 114,000 jobs from month to month from January to May. And now it wasn't all smooth sailing. The escalation of the conflict in Iran disrupted shipping through the Strait of Hormuz, sending benchmark crude oil to peak 2026 prices over $113 a barrel at points in March and April and May. And the Magnificent Seven, which powered markets in 2024 and 25, had very different first halves in 26. Meta declined 15% so far this year, Tesla dropped 7%, and even Nvidia, the world's largest company by market cap, has seen its shares trail the growth of the S&P 500. And one analyst put it, the Magnificent Seven was all the craze in 2024 and 2025, and now it's sluggish. You've got leadership in other corners of tech, especially chip makers. And this broadening of the market leadership historically has given us some of the healthiest bull markets. And this occurs when leadership expands beyond a narrow group of stocks. And that's really precisely what's beginning to unfold this year. Among the beneficiaries are going to be traditionally value sectors like large cap retailers, real estate, financials, and utilities. And that's actually a good sign for investors like us that are well diversified. All right, let's shift gears. It's summer, kids are out of school, vacations are being planned. I'm going away tomorrow, and frankly, nobody's thinking much about their 401k on a beach. But this is actually a great time to take care of a few financial housekeeping items. Here are my list for the top tips of the summer. First, I'll still be reaching out to do mid-year portfolio check-ins. You're 6 months in. If you haven't looked at your asset allocation or anything since January, now's the time. In your outside accounts, the ones that aren't managed, investors can take a look at this to review their portfolio and kind of understand their market exposure. And if in maybe other investments that you have, if it's shifted over time or you're over-invested in one sector or maybe cash, it might be time to do a rebalance. Given the semiconductor surge and tech volatility, a lot of portfolios might be more concentrated than we think. The second, review your cash positions. With elevated yields still sitting on uninvested cash, it's actually had a cost, but so does being reckless. Tech, energy, and healthcare are sectors to watch throughout the end of the year. And investors might also want to consider, hedging their bets with cash or gold amongst volatile market conditions. So we just want to make sure that your emergency fund is still, sitting in a high yield savings and that account is actually working for you. And the third is to check your beneficiaries. Summer often brings life events, weddings, babies, passing of family members. Take 20 minutes this month, verify your beneficiary designations on your retirement accounts at work, your life insurance policies, and I'll be checking next time we meet on all your investment accounts. This is one of the most overlooked but impactful tasks in personal finance. Tip 4, a mid-year tax checkup. With inflation at 4.2%, some incomes may have bumped into new brackets. Talk with your advisor, your CPA, about estimated tax payments, if we're considering Roth conversions for this year, and if there's opportunities to, adjust your withholding to make sure things are on track so there's no surprises in April. And tip 5, don't let a vacation derail your spending goals. Summer spending is real. Before you book that trip, make sure you have a plan. Paying for vacations on a credit card, if you can't pay in full, works against your long-term financial health. 20% down year in the markets can hurt the consumer, but consumer debt at 20% interest hurts a lot more. So what should we think about for the second half of the year? Here's a few themes that I think are going to matter most. The first is the Fed's next move. This is a big wild card. Dovish expectations of a rate cut were the narrative in the first half of 2026. Now an interest rate hike is being priced in, and there's more risk and less fundamental support from the Fed. We have to watch these meetings very closely, and a hike would likely rattle the markets quite a bit. The second is going to be oil and energy prices. The path of oil prices can determine whether stocks are going to soar or stumble in the second half of the year. And if crude benchmarks remain elevated or rise further, that could lead to an inflation push and keep those long-term interest rates higher and kind of knock down stocks at the margin. A resolution in the Middle East with tensions could be a major positive catalyst for this. And with AI, show me the money. Investors especially want to see how big tech is going to return and provide more infrastructure for spending with the AI boom. Q2 and Q3 earnings are going to be critical. If AI revenue growth doesn't start matching the capital, we could start to see some repricing. And 4, big IPOs that are on deck are things that investors are going to be talking about and have to consider with the AI fever. There's some public offerings. We saw SpaceX, OpenAI, Anthropic. These could be market-defining events for the second half of the year. And 5, midterm elections and tariffs. Tariffs now remain at 15%, and the midterm elections are looming. Political uncertainty tends to create short-term market noise, so we're going to stay focused on the fundamentals, not headlines like we talked about a few months ago, and we're going to try to balance this, with a bit of a split verdict. The earnings backdrop is the strongest it's been in years. The economy and the labor market have remained resilient, but risks are always real, and we should always be really careful about managing those. So That's your Soundview wrap up for 2026. The first half of the year was really strong, but the second half is going to require some patience and some discipline. So we're going to stay diversified. We're going to keep updating our financial plans, and we're going to keep that front and center. And don't let summer headlines or volatility shake you off course. As always, if you have any questions about how this applies to you or your personal situation, reach out to the team. We're here to help you. Thank you very much for watching. I hope you are enjoying your summer, and we'll talk again next month.